Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features a conversation with Tom Faughnan, the Director of Consumer Lending at Associated Bank. Associated Bank is a $35 billion bank based in Wisconsin that serves the greater Midwest area. Tom and I really dove right into the topic of machine learning and AI, both where the opportunities are to apply it to banking and more specifically to lending, but also how you think about managing the risks, both regulatory risks and uncertainty and internal stakeholders that might need to sign off, credit committees, compliance committees, vendor management. A great discussion on, I think, a very important topic. We dove a little bit into fintech partnerships, how you invest in that area, both finding the right partners to work with, managing the risk of the partners, particularly enterprise risk, which Tom was interested in, but also how you manage a little bit the internal stakeholders and develop a process around really becoming effective at fintech partnerships. Tom talked about their decision to buy an indirect auto business and get into that space to augment their mortgage space, and specifically what it was like to do that in a virtual world as opposed to an in-person world, which is a little more common for that sort of thing. And he gave us a couple of really interesting thoughts on what it takes to earn customer loyalty in the modern world. So I thought those were really interesting, and ended with a little bit of old school advice. So I'll have to listen to the end for that. But please enjoy this conversation with Tom Faughnan, the Director of Consumer Lending at Associated Bank. Tom, thanks so much for joining us today. I appreciate you making the time to join us on the podcast.
Oh, glad to be here.
You know, I was really interested in your perspective because we were talking a little bit about, and you said one of the main areas you like to discuss is AI, machine learning, and credit and banking. And like, I warmed my heart with that statement. So would love to get your take on kind of where we're at in the state of the industry and where you think the opportunities are and maybe the risks or the things holding you back from applying it more broadly.
So I think we are farther ahead in creating a machine learning environment, particularly when it comes to credit decisioning. And I will say that's predominantly on the origination side, but also could apply to loss mitigation efforts and techniques as well. And the benefits of those are multifaceted, but I think what hasn't happened yet is banks and regulators have not yet gotten completely comfortable with the outcomes, right? And frankly, it's new enough that there aren't a lot of outcomes out there to test. But I think that, realistically, it's what the consumer wants, it's what the banks want, and it's what, really what's going to drive the industry going forward. So we've got to figure out a way to come to grips with how it works, how it's going to work. Because frankly, regulators are used to testing models, right? Mm-hmm. And the models are static and they can look at it and they can test it, look at the outcomes and decide, yep, that works just fine. Where you're talking about a machine learning environment, it's a constantly changing environment. So how do you ensure that with that change comes predictive results that satisfy the fair lending requirements, as an example?
Where do you see, before we get into how we address some of those concerns, where do you see the biggest opportunities? Like, what's the value add to the institution? I think sometimes we get caught up in how do I get through the regulatory rigmarole, and we forget a little bit about why we want to do this in the first place and what the value add to the business can be.
Look, banks make money off loans. That's no secret. But the other thing is that the more we lend, the better we can do, and the broader our customer base becomes. So where you have traditionally unbanked, unlent markets, that's where the opportunity is. If you can show me a way that I can, with some certainty, be able to lend in those markets and make money and not suffer undue losses, I've created new customers. I've had additional relationships I can open up. So it really is an opportunity for us. We just need to be able to get there.
And do you have any thoughts on what helps bridge that gap, to your point? I think there's the changing nature of the models. I think that when in the AI/ML, there's a complexity of the model that's a little more sophisticated, that is harder for people to kind of wrap their mind around. Well, if these three things were different for this borrower or something, how do you think we kind of get regulators and I think not just regular credit committees, bank as institutions more comfortable with these kinds of approaches that can have those benefits?
Yeah, I think part of it is going to be time, right? To prove the model out, prove that the changing model can work. I think the other thing is, where we're bringing new customers into the organization, that's going to create a value proposition as well. And then, last of all, I think that, when we model it and look at it and have an acceptable loss rate, and we find that acceptable loss rate throughout the cycle, right? That's the other thing. Machine learning is relatively new and hasn't experienced the kind of downturns that we saw after 2010. There's models that have been used to mimic that, But frankly, in the real world environment, we haven't seen it proved out through a down cycle. So some of that gets back to what I said in the beginning, which is time.
Do you think COVID has been this interesting kind of down cycle? It looked from certain macro indicators, let's take unemployment as an example, that we were in a really bad place, right? Particularly middle of last year, it looked pretty scary.
Right.
And then you had this opposite thing where, for whatever reasons, government stimulus or others, realized credit losses haven't really seen the same kind of increase in risk or loss that you might have expected given what some of the macro indicators were telling you. How do you think about how much COVID and the experience kind of gives you some perspective on how these models will perform during, a less benign credit environment than most of the time they've been around?
It's funny because when you look at certain aspects of the pandemic impact, and you look at, for example, unemployment and the initial spike in unemployment, and then you've had kind of the retrenchment, we're back to, basically pre-COVID levels.
Yeah.
What did that look like? Well, I think that, the fact that government stimulus was really so broad-based that it really prevented, because you think gut stimulus includes forbearance, and includes, so basically people are getting supplemental income and not being obligated, not being forced to meet their credit obligations, through the forbearance process, which by the way, was altogether needed to get through this, but it really did create an artificial barrier that otherwise would have resulted in kind of a catastrophic, economic impact and credit losses. So, I think it really was because of the steps that were taken by the government. It did really mask what could have been a really horrendous. And we're not out of it yet, right? I mean, we're starting to see inflation pick up again. We're starting to see other factors that, could lead. Now, can we manage our way out of this process? Yeah, hopefully we can. I mean, but I think we're well prepared, to manage through the process with what we've got already. But those are some of the things that need to happen to get us through the cycle, to have a proof point, to be able to say, see, it does work.
Yeah, I think that's right. And I think, there are certain signals we saw during the crisis, for instance, models, predictive power about maybe entrance into forbearance and recovery from forbearance that gave you, at least something closer to a proxy for what loss acceleration might have looked like, absent government stimulus and forbearance programs and things. So I feel like at least we've got a few more data points about the survivability of these models through an economic downturn than we did, pre this experience. But you're right; it's been very interesting. I think we're going to see some sort of reversion, at least to the mean, here, because the stimulus has kept you in not just a neutral environment, but like a really benign environment.
Right.
Quite frankly.
Yeah. Exactly. Yep.
And I want to ask. Oh, go ahead.
The other thing about the models is it uses non-traditional metrics to help inform credit decisions. And that's something that the industry and regulators are not used to relying on. And how does it work? What are the outcomes? And again, that's a time-based, right? We're going to see what that looks like over time. But it also opens up greater opportunities to provide credit to traditionally unbanked, unlent markets. And that's an important attribute that, can't be overlooked as well.
I think that's right. I think it's interesting when you talk to regulators about this area, that there's the fair lending laws. But at the end of the day, the thing that always I remember is that many more Americans are credit worthy than are traditionally prime type credit. You could just, in any pool of high risk loans, the majority of people still pay back, right? Which is to say, many of them were good credit risks. And any model that can help you serve that population is going to help. The populations that are traditionally underserved are going to be more aided by that kind of increase in accuracy than others. So I think it could be helpful to keep in mind that objective of saying, hey, we need to apply the fair lending laws and we want to make sure we're following them. But let's also keep in mind the objective of increasing the population that we can serve and taking people who were unservable before and bringing them into a more traditional financial product, which is I think really valuable.
Which not only helps the community, it helps the financial institution build households, build families, right? And so I think it's a win-win all around. It's just a matter of it's a very new paradigm, and how do we feel about that? How do we get comfortable with that?
Yeah, and as you said, sometimes it just takes time. I know one of the other things it takes to build these kinds of models is kind of expertise that often doesn't exist in banks, which leads to this kind of partnership with newer technology or fintech type companies. How do you think about, navigating the question of not just a model, let's say, but how do I find a good partner that I can rely on to be a partner in the space? How do you think about fintech integration into the bank? I think it's a huge topic and an interesting, just general area.
It is. And as somebody who's looked at a lot of fintech providers, it's hard. There's a lot of great ideas out there. There's a lot of great, alternatives, but which ones work? Which ones? Because most fintechs are still early stage, typically maybe unprofitable, maybe VC funded, right? And which ones of those are going to survive into a production environment, create a profitable business, and be able to continue to move on? Because you don't want to get halfway down the process, make a significant investment in a fintech, and then have the fintech go away, right? Because now you've lost that investment. You're now behind, what could potentially be other peer groups that you're relying on, and you want to take market share from. So it's a very challenging. And I would also say that we're getting better, but the traditional vendor management process in most organizations wasn't designed to be able to look at an unprofitable business and say, yeah, I want to leverage that unprofitable business. I want to use that vendor and make sure, make some pretty big investments of my own there.
Yeah, it's interesting because I hear a lot of banks or credit unions talk to me about analyzing the capacity of a fintech to serve a compliance program. But your point about the operational risk of how survivable is that business as an entity to continue working with is a really interesting one. And it is probably pretty hard to think about in the context of an unprofitable business. I mean, most models would go cash minus burn rate equals out of business in X months, which is, a traditional banking model would go, that is not a good, wouldn't lend money to them.
Yeah.
So how do you bridge that divide? Have you found any secrets to how you think about finding companies you're comfortable with that are maybe, obviously, certain of them get to profitability and growth and the number, but are there metrics you look at that get you more or less comfortable with investing in a fintech that maybe isn't at that profitable stage?
First of all, I think you need to have a good and understanding vendor management group. I mean, they really need to understand the landscape, the true benefits that the attributes of the fintech can bring to your organization. And then you've got to be able to say, okay, well, you got to have an understanding from the fintech. What is your path to profitability? Tell us what your business plan looks like, because nobody's going to get in here. Some exit strategies are, we just want to get bought, right? And typically you don't hear that. Typically it is, how do I become profitable and what's my investment? And typically it's future rounds of additional investment. And, you look at the list of investors who are, involved in the company, and you look at their track record and you say, you know what? Okay, this is probably one that, I can take a significant amount of risk with because I think that they've got a good product, a good track record, a good investment community behind them, and they're probably going to be one of the ones that does make it.
Yeah, I can say you may not, exit strategy is one thing, but usually companies like to buy companies they find that have a path to profitability too. So whatever your exit strategy is, you kind of need a path to making money in your business or you got a fundamental problem.
Right. Yeah, exactly right. Well, and I think that, with that, there can be, okay, what is, maybe there is a play for the technology being used that goes beyond what it's currently being used for, right? If you can find a new use case for the technology, that can open up a whole new set of doors.
Yeah. How do you think about helping the vendor management process internal to the institution get improved? This is I'll say, I see in a lot of my conversations with banks and credit unions that they see the value in partnering with, different kinds of organizations they have in the past for the future of the organization, but the muscle around how do I get good at diligencing from a, not just a operational risk, but maybe it's credit policies, maybe it's, regulatory risk, other things. How do I get the various stakeholders inside into a process where we can actually execute and test our way into success with folks? Feels like a critical capability for institutions to build, quite frankly, if they want to be good in this space. And I'm curious how you think about building that organizational muscle, because it runs a little bit counter in some ways to the history of what those groups are meant to do inside the bank, which is prevent risk and slow things down a little bit.
Right. Yeah, you're absolutely right. And it does. I mean, I talked about the vendor management piece before. That's certainly a key partner. But so is, in a lending environment, so is our credit risk partners. They've got to have a clear understanding. And then your IT partners, right? So they're the ones that, have probably the best, deepest understanding of what the technology is and what the roadmap to that technology looks like in the future from their perspective. So you need all of those parties plus the business line to be in a situation where you can sit in a room and talk about it, not be afraid to, talk candidly about it, but understand that, what are the benefits? So sometimes the risks, they talked about a lot, the potential benefits don't. And you need to make sure that it's a balanced conversation that way. And, find a way, and it's not always a pure technology play out of the box, but it may be, okay, vendor, if you do X, Y, and Z, I can see a way that we can use your technology, but I need these risk mitigants to be in place in order for us to do that.
That's interesting, coming back with here's what we need to get comfortable. I imagine many fintechs would appreciate the clarity that provides versus the kind of like, sometimes we just couldn't get it through the committee. It's not helpful to the like, hey, what's it going to take? Like, what do I have to do to get to a place where you're going to be comfortable doing this sort of thing?
Well, because typically if you give that answer, you're going to get a constructive response, right? One that you may actually be able to work with. And beyond that, from a fintech perspective, I've got a partner who's now able to help me build a product that may be more saleable in the general marketplace. So, it can typically be a win-win.
Yeah. And do you have any structure for how or thoughts on how you engage those partners or when you engage them? Your point about making sure value, not just risk, is displayed, I think is really good. Because so many times I think of it kind of like my lawyer, I hope my GC doesn't listen to this, but like so often lawyers feel like their job is, not they feel like it feels like they're coming in to like review at the last minute, tell you all the risks and kind of say no. And really I think the best ones are there to say, how do we understand the risks, find ways to limit them, and kind of partner with you to help you achieve the value that you see while limiting the possible downsides.
Right. Yeah, well,
I'm curious how you think about creating that relationship with other.
Right. So that's the difference truly between risk mitigation and risk avoidance, right?
Yeah.
So it's easy to avoid risk. You just say no all the time, right?
Don't do anything,
but typically you wind up aging out of the market if you do that. If you start to figure out ways to mitigate the risk of the new tool that you're looking at, and you understand what the benefit is, the features and benefits of that tool are, you should be able to manage your way out. And you do it by developing relationships with the peers that you need at the table, right? And those relationships need to be candid, right? You're not saying you want to just be somebody to be your buddy so they say yes, because you want to make sure you vet out all the risks, you understand the risk, you've mitigated the risk, and then you stand back and go, okay, is my residual risk and the reward adequate based on what we identified as the inherent risk?
Yeah. I always love those concepts from we go through our same compliance reviews and kind of like the inherent risk, the mitigants, and you can be pretty creative in some of your mitigants, the size of a program, for instance, or where you're deploying a technology, other things that can limit the risk, what's the remaining risk down to a pretty manageable thing, even if the inherent risk is harder to eliminate or reduce dramatically.
Well, and quite candidly, that's where, things like creating a buy box, it says, okay, here's how much risk I'm willing to take in this space. Right. And typically it's balance sheet space or something like that. Yep. And you say, okay, I think this product's got value. I think we've mitigated the risk to a point where I'm willing to go this far. Then we get the experience and we see, okay, do we want to go farther? Are we more comfortable now? Have we been through some reviews that give us more certainty around this product or process?
That's another great point, is the leverage of time to get to understand and mitigate the risks. Actually say, hey, we launched small. Not that, because I often hear, well, we can only do this and it's not worth the effort. You go, well, this isn't the end result. This is where we start and how we build up the comfort and the history to go bigger. And so that idea of that, keeping it small to start is a risk mitigant versus having to, boil the ocean, so to speak, solve all the problems just to get a new product or initiative out the door. It's a really interesting approach.
Exactly. Yep.
Now, I understand you took an interesting growth approach during the pandemic, or diversification, and actually acquired a new business. Tell me a little bit about what drove that decision and what it's like to go through a transaction like that when we're all meeting virtually and not in person.
Yeah. So we are the organization that I work with, Associated Bank, is a $35 billion Midwest-based bank. We have a very heavy, and we're very good at mortgages. But it also became a very large portion of our balance sheet. And we were looking for strategies to keep that mortgage business going and robust, but to diversify at the same time.
Yeah, put something else on the balance sheet. Yeah.
Right. So we looked at several other business lines, and one of the business lines we looked at was indirect auto. And, during the pandemic, I made a contact in the indirect auto who I'd known for years. We rekindled our discussions, and frankly, he was in a position where he and the team were ready to make a move. And we were able to negotiate the move over, negotiate some of the technology to come with it, and stand up an indirect auto business in 7 months. It's a great seasoned team. We are, frankly, in footprint states that it will be in footprint states in the second quarter of next year. But we took their existing footprint and we just, stood that up on our software with their team, and frankly did it in record time. And we're very pleased with the results and very excited about the prospects for the next couple of years.
It's fascinating to me because I hear so many banks skeptical of indirect auto or concerned about the lack of real customer relationships they build, the thinning of the margins. I've talked to several that have basically run off their portfolios and said, I'm out of this game. I'm not originating. I'm going to either sell or just run off the portfolio. So I'm curious what it was about that business that made that an appealing thing for you guys to use to diversify the balance sheet away from a very mortgage heavy basis.
Yeah. So I think, if you think about the mortgage space, it's a traditionally, especially the way we do it, we're a prime lender, right? We don't do subprime. We don't do near prime. We look at that and we say, okay, well, mortgages are great. We do it really, really well, but it is a low margin, long duration business, right?
It is a tight business, for sure.
If you're going to diversify, if you think about auto, it is probably the second leading asset class for most consumers. And it is shorter duration. It is higher yield, even though the yield may not be, the highest in your portfolio. But it is accretive to our yield, and that's important. And we could do it with a group that knows it really well and has a lot of great contacts in the industry. So I think all of those reasons were very good reasons for us to take that step and diversify using the indirect auto space. And our mix of indirect auto is predominantly in the used space. We do a fair amount of new business as well, but new car business. But we do a lot of used car business, and that typically comes with a little bit higher yield.
Yeah, that is fascinating that you find that trend. I guess it all depends on your perspective. If you're coming from a high yield business, it looks thin, and if you're coming from the prime mortgage business,
right,
it's heading the other direction.
Exactly.
That was fascinating for me. And I did want to ask, since your primary space is mortgage, what do you see happening in that space, particularly as rates rise? We talked about broadening access through things like AI, ML, and that's going to kind of fight the other way, right? Where we're going to be narrowing the box, or at least the population we can serve as rates rise. What do you see happening, and how are you guys thinking about adjusting to the reality as these things kind of come into reality?
Yes. So, obviously, as rates rise, refinance transaction opportunities go away. So you're left with a smaller market that is focused on purchase money. So that's existing homes, that's new construction, and it's multifamily, obviously. But I think if you think about the first two of those categories, they are critical categories that as you continue to have home price appreciation, which may be slowing but continues to appreciate, if you have slower wage growth than the home price appreciation, the affordability gap widens. So how do you now serve for those gaps and people who want to own their own home? You've got to come up with creative ways to do that. And typically, that may be, additional asset support. So it may be through grants, it may be through high LTV products. You've got to look at not only the affordability, but you've got to look at it from a different perspective. How are we going to go about doing that? How do we find the borrowers? What differentiates us in a market that's already overcrowded with refi lenders that now have to figure out a way to keep their business going? And how does that competition look? Who's rational? Who's not rational? So all of that will, kind of work out over time, but it does create some unique challenges that we haven't had to face in quite a while.
Yeah, it's been a while since we've been talking about this kind of environment coming our way. Right. And certainly some of the newer tech-enabled, particularly the refi-oriented lenders, I think are in for as you said, that refi business is going to get pretty thin and pretty tough to execute as rates go up. So that's going to put a lot of stress on everybody.
Yep, exactly. And I do think that the lenders that do it well and have good, deep relationships in the purchase money space will continue to do well. I do think that, one of the things that technology is helping us with is get from application to closing a heck of a lot quicker, using the same degree of certainty of, authenticated information, whether that's assets, whether it's liabilities, whether it's income and employment. If you can get there sooner, you get a lot more nimble. It also, if you think about it, a 60-day or 45-day pipeline takes a lot of people to manage. If you now have a 10 or 15-day pipeline, that's a lot less management that goes into the process. So if you can do that routinely, right, for the majority of your population, that's going to be, a distinct advantage in the world that we're going to live in going forward.
Is that an area you guys are making investments? I'll say it's maybe for us the place that we kind of underappreciated the value, not just of being smarter about who's creditworthy and not, but of how quickly you can get to hey, I'm confident in this application. We don't need to put any more hurdles in this borrower's way. Let's get them originated and shrink that time. And it feels like, to me, in the industry, a somewhat underappreciated part of what the technology platform needs to do is not just digitize what we're doing, but really optimize the efficiency of that, that whole end-to-end process and removing the friction and the effort required of the borrower.
Well, and even and we've got some partners in that space that help us with that technology, but even those spaces have 35 to 50% success rates because typically providers of the information haven't participated in that robustly enough, right? So if I don't have a payroll company that's doing business with my vendor, well, that's not going to be a hit for me. I'm going to have to go back and do it the usual way, which is going to take longer. Okay. The other part of the process that needs a lot more attention is valuation. So valuation, I think if you were to ask most lenders over the course of the last year, has become one of the biggest challenges in trying to, generate adequate turn times. And that's for, both our mortgage business and our home equity business. And we think those are great opportunities for the future, but we need to be able to come up with a better method to do it because the appraisal process is still about the same as it was years ago. And it does use technology, but it takes far too long to come to a valuation determination that's acceptable and we're willing to go with. So that's the part that we're working on as well.
How much of these solutions do you think are technology and how much of them are process things that you need to change or fix or rethink, whether it's a policy or a process versus just the application of technology?
It's going to be both. It's going to be both because where you're looking at at regulations and policies that require a lot of manual work to come up with a result. Well, if you don't allow for technology in your policy, then you're never going to get there. So the policy's got to come first, but the policy is going to be informed by the technology, and you've got to be comfortable with the technology in order to change your policy.
Yeah, it's a great point. I see some banks are like, well, we're going to apply the technology. I'm like, if you don't have a policy that's going to accept just AVM as a simple example for certain kinds of transactions, you go, technology can't fix that. You got to have the two acting in coordination. And again, where are your risk mitigants? I'm not going to do that for everything, but are there places where we can?
Well, right. So the more room I have on value, let's say value determination misses, right? So 60% loan to value as opposed to a 95% loan to value. You know what? Maybe I can afford it in that space. I can't afford it. I got to go out and get a full appraisal. So that makes better use of the resources in the field too, because you're only getting it on that, one segment of the population.
Yeah, you're applying those resources where they are really making the biggest risk difference to the calculation for the institution.
Exactly right. Yes.
Love it. Well, I've gone through most of the questions I had for you. Are there topics or areas you wanted to dive into that I forgot to ask about today?
I don't think so. I think, customer loyalty and customer use. So we've talked about AI, we've talked about machine learning. At the end of the day, the person on the other end of the transaction is a person. It's a consumer. And you've got to find a way not only to use technology effectively to create a great customer relationship and a great customer experience, but you've also got to be able to support that when a customer says, I need a zero-out option, right? I want to talk to somebody. And, chatbots are kind of in their infancy. I will tell you that chatbots have typically we've struggled to effectively use chatbots because they don't interpret the question the right way. So then the consumer becomes frustrated. So I think there's some more to be done there, but you've got to be able to provide a zero-out option for your consumer and one that's effective. So chatbots are okay, but they got to understand the question.
I thought chatbots were such a fascinating place for financial institutions to apply MI to start, or ML and AI, because it's like a really hard problem. It's like natural language processing plus like a nearly infinite problem space for things you can do. And I kind of always looked at it compared to, like, let's say a risk underwriting model with like really clear inputs, really clear outputs, really great training. You go, what? That's like a tailor-made problem for ML team. And then you go, like, somebody types in a question and you got to figure out what to do. Like, that's like nearly the hardest problem for an ML team to do. That seemed to be where we went first. So that was always a fascinating development to me, that they was like, I think this is going to be harder than you think to really, I mean, like maybe skipping the IVR and like an IVR equivalent of like, here's four things in a chatbot's one thing, but ask me a question and I'll give you an answer. It's hard.
Well, it is, but the other thing is, how many people have you talked to that go through an IVR and go, it's by the time you get to where your question is in the IVR, it's forget it. I'm 20 minutes later, I'm frustrated, I'm gone. So I do think it's an evolution in technology that needs to take place, but you're right, it's a big lift.
It is a big, and I love your point that, like, it needs to be easy to, I find this, the technology is so great at simplifying transactional things, but then please don't make me go through a big IVR or 20 stages in a chatbot to go, I got a question. I need to talk to a human being. I don't want to check my balance. I don't want to make a pay. I know how to make a payment on your website. I didn't call them. I didn't want to talk to somebody. And making that seamless and quick and easy, I think is really valuable, because in those moments when you need it, you really value making that accessible and fast.
Yep. Agreed.
All right, Tom. Well, I've got 3 questions I ask everybody at the end of the podcast. So I'm gonna fire match you, and we'll see what you got.
Sure.
My first question is, what's the best piece of career advice you've ever gotten?
Work harder than everybody else.
Work harder than, now that's like an old school answer. People don't like to just hear that answer or give that answer anymore, but just work harder than everybody else.
Harder than everybody else. Yep. Be the last guy out. You're right. It's very old school, right? And not always popular with the current environment. But work hard.
I sometimes tell my kid this. It doesn't take talent to work hard.
Nope.
Just put the effort in. Nobody can take that away from you.
Well, frankly, look at the football games that took place over the weekend. There was a lot of hard work there that led to that. So, yeah.
There's a lot of hard work behind that. All right. Work harder than everybody else. I like it. First piece of advice. Second, what's the best piece of advice you've gotten around consumer lending or consumer banking?
Don't forget about the person at the other end of the transaction. Right? Because if you put yourself in their shoes, not that you're going to make bad decisions, but you're going to be much more empathetic to what they're going through and be much better able to communicate your decision and why.
I love that. Putting the customer first and kind of understanding their perspective, so valuable in any business, but particularly I think in a finance business where it's easy to lose the people in the numbers, if you will.
Exactly.
Forget about what you're really here for. So last question for you. What's one bold prediction about the future?
Well, I would say bold prediction. Banks are going to get better at this, but they're not going to be the only ones in this space.
Who's going to be in the space other than the banks?
They could be bank-regulated fintechs. I think that there are a lot of
more of those now.
Yeah, and there are, frankly, they're going out there, they're getting smart, they're doing it tactically. But I think what's going to happen is they're going to get refined a little bit, which is probably good, right? They got to be subject to the same level of regulation, but to make sure they're doing the right things. But at the end of the day, they're very nimble, and they're thinking outside the box, and that's what we've got to do in order to make sure we're there.
Do you think banks are going to figure out how to be as fast as the fintechs? I like it.
Have to.
Well, or maybe not as fast as the ones that are the move fast and break things crowd. Maybe we don't want to be quite that fast.
Yeah,
move fast and don't break things. Maybe that's a good objective.
Exactly. Yep.
All right. I like that. Good way to end the podcast. Tom, thanks again for making the time. This was a fascinating discussion. I appreciate you making the time for it.
Thanks, Jeff. I appreciate it.